Attention all investors and aspiring traders. Are you ready to embark on a journey through the dazzling world of stock markets? Today, we have a captivating video that will take you by storm as we unravel the intriguing differences between US shares and UK shares. Get ready to dive into a realm where market size, regulations, trading hours, and sector focus collide, providing you with the knowledge to make informed investment decisions. Whether you're a seasoned investor or new to the game, this video will equip you with the insights you need to navigate these two powerhouse markets. So grab your notepads and let's unravel the secrets of US shares versus UK shares. US shares and UK shares are both types of equity securities that represent ownership in a company. When you buy a share, you become a shareholder of the company, and you have the right to receive dividends, vote on important decisions, and benefit from the growth and profitability of the company. However, US shares and UK shares are not exactly the same. There are some differences between them, such as the terminology, the currency, the market, the regulation, the taxation, and the performance. These differences can have an impact on your investment strategy, returns, and risks. In this video, I'm going to explain to you the main differences between US shares and UK shares and how to choose the best one for your portfolio. The first difference is the terminology. In British English, shares is more commonly used than stocks, especially when talking about individual listed companies. In American English, stocks is more commonly used. In either the UK or US, however, there is no practical difference between the terms stocks and shares. The second difference is the currency. US shares are denominated in US dollars, while UK shares are denominated in British pounds. This means that when you buy US shares, you have to convert your local currency into US dollars and vice versa when you sell. The same applies to UK shares, but with British pounds. This also means that you are exposed to the exchange rate risk, which is the risk of losing money due to the fluctuations in the currency value. For example, if you buy US shares when the US dollar is strong and sell when the US dollar is weak, you will lose money, even if the share price has not changed. The same applies to UK shares, but with the British pound. The third difference is the market. US shares are traded on various stock exchanges in the US, such as the New York Stock Exchange, NYSE, the NASDAQ, and the American Stock Exchange, AMEX. UK shares are traded on various stock exchanges in the UK, such as the London Stock Exchange, LSE, the Alternative Investment Market, AIM, and the FTSE Fledgling Index. The US stock market is the largest and most liquid in the world, with a market capitalization of over $40 trillion as of November 2021. The UK stock market is the fifth largest and most liquid in the world, with a market capitalization of over $4 trillion as of November 2013. The US stock market is also more diversified and innovative than the UK stock market, with a wider range of sectors, industries, and companies. The UK stock market is more concentrated and traditional than the US stock market, with a heavier weight on sectors such as financials, energy, and materials. The fourth difference is the regulation. US shares are regulated by the Securities and Exchange Commission, SEC, which is the federal agency that oversees the securities industry and protects investors from fraud and abuse. UK shares are regulated by the Financial Conduct Authority, FCA, which is the independent regulator that oversees the financial services industry and protects consumers from harm. The SEC and the FCA have different rules and standards for the listing, disclosure, and trading of shares, which can affect the availability, transparency, and compliance of the shares. For example, the SEC requires companies to file quarterly and annual reports, while the FCA requires companies to file half-yearly and annual reports. The SEC also has stricter rules on insider trading, short selling, and market manipulation, while the FCA has more lenient rules on these practices. The fifth difference is the taxation. U.S. shares are subject to various taxes such as capital gains tax, dividend tax, and withholding tax. Capital gains tax is the tax that you pay on the profit that you make from selling your shares. Dividend tax is the tax that you pay on the income that you receive from your shares. Withholding tax is the tax that the U.S. government deducts from your dividends before paying them to you. UK shares are also subject to various taxes such as capital gains tax, dividend tax, and stamp duty. Capital gains tax is the same as in the US, but with different rates and allowances. Dividend tax is also the same as in the US, but with different rates and allowances. Stamp duty is the tax that you pay when you buy UK shares, which is 0.5% of the transaction value. The taxation of US and UK shares can vary depending on your residency, citizenship, and tax treaty status. You may also be able to claim tax credits or deductions for the taxes that you pay in the other country to avoid double taxation. You should consult a tax professional for more details on the taxation of US and UK shares. The sixth and final difference is the performance. US shares and UK shares have different historical and expected returns, risks, and correlations. According to the Barclays Equity Gilt Study, US shares have delivered real returns of 5.5% over the past 20 years, while UK shares have delivered real returns of 1.7% over the same period. US shares have also outperformed UK shares in the past year, with a return of 19.1% versus a loss of 9.8%. US shares have also been less volatile and more diversified than UK shares, with a standard deviation of 15.2% versus 17.4%, and a sector concentration of 27.6% versus 41.1% for. US shares and UK shares have a moderate correlation of 0.7, which means that they tend to move in the same direction but not always to the same extent. So these are the main differences between US shares and UK shares. And these differences can have an impact on your investment strategy, returns, and risks. But how do you choose the best one for your portfolio? Well, that depends on your goals, preferences, and risk tolerance. Here are some factors that you may want to consider when choosing between US shares and UK shares. Diversification is the practice of spreading your investments across different assets, sectors, and markets to reduce your overall risk and increase your potential return. Diversification can help you to smooth out the volatility and unpredictability of the stock market, and to capture the growth and opportunities of different regions and industries. If you want to diversify your portfolio, you may want to invest in both US shares and UK shares, as they have different characteristics, drivers, and exposures. You may also want to invest in other markets, such as Europe, Asia, and emerging markets, to further diversify your portfolio. Valuation is the measure of how cheap or expensive an asset is, based on its current price and its expected future cash flows. Valuation can help you to identify the potential upside and downside of an asset, and to compare the attractiveness of different assets. If you want to invest in undervalued assets, you may want to invest in UK shares, as they are cheaper than US shares based on various metrics such as price to earnings, price to sales, price to book, and dividend yield. UK shares have been trading at a discount to US shares for several years, due to factors such as Brexit, COVID-19, and sector composition. However, this discount may narrow or close in the future as the UK economy recovers, the Brexit uncertainty fades, and the UK market re-rates. Growth is the measure of how fast and how much an asset can increase its earnings, revenues, and dividends over time. Growth can help you to benefit from the compounding effect of reinvesting your returns and to capture the potential of new technologies, trends, and innovations. If you want to invest in high-growth assets, you may want to invest in US shares, as they have higher growth rates than UK shares, based on various metrics, such as earnings growth, revenue growth, and dividend growth. US shares have been growing faster than UK shares for several years, due to factors such as innovation, digitalization, and globalization. However, this growth may slow down or reverse in the future, as the US market faces challenges such as competition, regulation, and valuation. Based on these factors, you can compare and contrast US shares and UK shares and find the best one for your portfolio. You can also invest in both US shares and UK shares, depending on the situation and the purpose. For example, you can invest in US shares for growth and innovation and invest in UK shares for value and income. You can also adjust your allocation and exposure to US shares and UK shares based on the market conditions and your risk appetite. You can also use exchange-traded funds, ETFs, or mutual funds to invest in US shares and UK shares, as they offer diversification, convenience, and low cost. And there you have it, a comprehensive comparison between US shares and UK shares. Both markets offer unique advantages and considerations for investors. The US market's size and global influence make it attractive for those seeking a diverse range of investment opportunities, while the UK market's historical significance and regulatory framework provide stability and potential growth. Ultimately, the choice between US shares and UK shares depends on your investment goals, risk tolerance, and understanding of each market. It's crucial to conduct thorough research, seek professional advice if needed, and diversify your portfolio to mitigate risks. Thank you for joining us today. If you found this video helpful, please give it a thumbs up and subscribe to our channel for more insightful content on investing and financial markets. Remember, no matter which market you choose, always invest wisely and stay informed. Happy investing!